Welcome to the Creating Wealth Simplified podcast. My name is Lauren Wells, here with my co-host, Chris Seveney. We're committed to providing you with the knowledge required to build wealth through real estate investing. Tired of consuming content about real estate? Stuck in analysis paralysis? Ready to do your first deal? As a member of our community, you will learn how to go from consuming content to taking that first step into the world of real estate investing. Our show is not about getting rich quick, but about providing you with the knowledge you need to take action. Join us as we speak with experienced investors who share action tips on how to escape the corporate world, start a thriving side hustle in the world of real estate, and go beyond your W-2 or 401k.
Welcome back, everybody, to another episode of the Creating Wealth Simplified podcast. I am your host, Chris Seveney, and today I'm going to have an episode that I'll call it kind of potpourri, probably going to bounce around a little bit. I want to talk a little bit about what we're seeing in the space, real estate space, I should say, for people who are investors out there. I want to share a case study of a very hard lesson learned. And then I'm going to talk about a really controversial topic, and it's the definition of accredited investor. And I'm going to get a lot of haters on this, I know, but I want to talk about it because I want to share my opinion, some thoughts, and love to hear other people's opinions on this because mine is probably going to be very different than a lot of other people's out there. So let's get into it and start. I want to start with in real estate in general. And as many people probably know, I enjoy being on some of the forums, especially on Bigger Pockets, providing content, education to people on there. If you're not on Bigger Pockets, I get nothing for saying this, but it's a good site to be on. I recommend being on it, and you can learn a lot. There's a lot of forums on there. At times I might be a little brutally honest with people, but I feel that's the case because, I see people continue to make mistakes that are unavoidable. We're all going to make mistakes. I'm not perfect. I make lots of them, but there's certain mistakes that I think are easily avoidable for people who might be inexperienced or just trying to take a shortcut. A lot of talk, a lot of rumble. They're actually coming out with a website called Passive Pockets, provide limited partners more information on investment opportunities and certain due diligence. I don't know what it costs. I don't know what it's going to be about, but should be some good content because right now a lot of sponsors are getting crushed on Bigger Pockets. And the main reason, honestly, is lack of communication. A lot of the multifamily deals today, thankfully not multifamily, are losing and cannot preserve the capital. They're doing capital calls. Distributions are being ceased. It's an investment. Some investments go bad. Just because it doesn't mean the person's running a Ponzi scheme, doesn't mean, the person's awful this or that. That will come out of, that all gets flushed out. And as a sponsor, there's certain things that are out of your control. One thing that is 100% absolutely in your control is how you communicate. And that's one of the biggest problems we're seeing right now. See one sponsor who is out there that changes their name, out there raising money for new opportunities, completely ignoring some of their other sponsors or other limited partners. One has even accused them of not even being advised that the property even got foreclosed on and they got completely wiped out. Another offering out there where, again, the CEO, and I mentioned this past, touting about their new office. He's got his own private bathroom. They ceased all distributions. There's rumblings that they got a notice by the SEC to be reviewed, but this person's hosting conferences, training programs, opening up new funds to raise money, but not communicating with their current investors. So not a good image. And I think part of that boils down to lack of experience, immaturity, as well as, what's the team that you have in place? One of the things that I like to brag about at Seveney is we have our investor relations team in-house. They know our product. They know what's going on. They're there to answer questions. Now, some people may not like answers to certain questions, but you're getting an answer. So I wanted to share some knowledge on that because what's happening is people who were invested in some of these investments now are going apoplectic and I've been lied to. It's a Ponzi. I'm losing money. Like all these things. And I'm reading, and some of these people are like, I gave this person $300,000. It's my life savings. What can I do? How do I get it back? Another person gave close to $800,000. Another person said, hey, it was my only $50,000. So this is where I want to get into the conversation of an accredited investor. So first definition, don't quote me on this. You can Google it. Income of $200,000 per year. Single, 300,000 combined, or net worth over $1 million outside your primary residence, or you have a specific, FINRA license. So let's talk about the net worth, $200,000 because that's really what I want to focus on things. And those numbers where, the government came up with that definition, don't quote me on this, but are approximately 40 years old. They're from like the 80s. Now, little, thought process that, remember, I believe Nolan Ryan was the first baseball player ever to get $1 million a year salary. I think that was like in 1980. Now, the average player now is signing, $500 million deals and getting $50 million a year. So when you look back at then, an accredited investor was someone back then who was really flipping wealthy and had a lot of money. And I was not even 10 years old at the time, so I can't tell you how much any type of syndications or if syndications were even allowed back then. The whole intent of accredited investors in 506Cs, which are fund offerings a lot of people will invest in, are essentially, hey, look, there's a risk you could lose everything. So it's okay because you're accredited, means you got a boatload of money, so it's okay to lose. The reality is today, if I picked 10 of my friends who make $200,000 a year, half of them probably don't even have $50,000 in savings. And the ones that do could not afford to lose it. I'm actually a proponent of increasing the accredited investor definition. And do I know what the right number is? No. I mean, if you actually took it for inflation, I think the number is over like $1 million a year in income and $3 million in net worth. Now, is that the right number? I have no idea. I'd probably go, maybe $400,000 or $500,000 a year. Is what kind of where the government starts taxing everybody. And I know that will tick off a lot of people and say, well, then only the wealthy get the opportunity to invest in some of these options. True, but false. Because look at 7E. We run a Regulation A+ offering. The Jobs Act that came out allowed now for investors to offer products to non-accredited investors at a much lower price point. Our offering doesn't have a $50,000 minimum. You can get in for $5,000. So my friend who has $50,000, they could drop $5,000, or some of these go down to $1,000 or $10,000, drop some of this money in several different offerings, because every scholar will tell you not to put more than 10 to 20% of your money in one investment. And I truly believe that. You don't want to put all your eggs in one basket, because we've seen some of the downside of that where people will have 100,000, say, okay, 2 multifamily deals, here we go. And that's really not diversification because you're investing in the same asset class. And if it goes bad, if you have a market challenge, which we had, then you're probably losing them both. And I think people forget how hard it is if you take a loss. Now, if you have $100,000 and you make 15% on it, great, you made $15,000. But if you took a 50% loss or even a 15% loss on that, to get back, you got to basically be at like 25% return. And typically when it goes bad, you don't turn that switch and it gets back to those returns. It's usually, okay, let me flatten and slowly build up. Losses would probably take 5 to 7 years to recoup. And are people who, making 200 grand, which I think there was a report coming out that like 30% plus of the economy would technically be an accredited investor by 2027. Kind of scary. So what should they do? And I know a lot of people think, oh, they should lax the rules to let more people take a test or whatever to be accredited, because just because you make a lot of money doesn't mean you're a smart investor. But what it does typically mean is you probably have more flexibility to handle a loss, which again goes back to my thought on this, is because they did come out with things like crowdfunding and Regulation A, which, limits the non-accredited people how much money they can invest. There's avenues for both accredited and non-accredited, who we really don't have a middle class right now, can get into those opportunities. What's also beneficial about them being somebody who sponsors a Regulation A offering compared to having done a 506C is you have audited financials, there's annual reporting, there's a lot more steps in the process that have to be taken in order to continue with your offering, compared to a 506C, which is, hey, you invest, great. I don't even need a PPM. I can say, throw you a K1 every year, and that's my only reporting I'm going to do. It's very, very different. I don't want to use the term lax, but there's less requirements on an investor. And personally, I think the people who are making, again, $200,000 should have more protection, because I don't consider anybody today with a $200,000 salary as wealthy. Now, is it a lot of money? Yes. Don't get me wrong. I know people are listening to this might a lot less. I'm not diminishing saying anything in regards to, it's a lot of money, but it's not life altering like it may have been 40 years ago compared to that timing, where in a lot of places, what's the average home now? 400,000. It's 7% mortgage, 300. I mean, you have to make like $120,000, I think, just to afford the average home here in the United States. Back in the 80s, I think you probably need to make 20,000. Think of it from that perspective. That's the point I'm trying to get at is, are we really looking out for investors' best interests because of this? And I know a lot of people, again, will push back and say, no, it should be less, and people should actually have to take a test or be more educated. But who's going to initiate that test? Who's going to provide that type of test? I mean, is it going to be a specific license? Anytime you get the government involved in licensing something, it just turns out to be extremely challenging, a lot of paperwork, and you don't know which way is up. Whereas, again, I already think they've created that path through Regulation CF and Regulation A off. I wanted to share that with people because seeing a lot of people upset that they're losing a lot of money, and unfortunately, a lot of them put all their eggs in that one basket. Last thing I wanted to talk about today is, and it kind of goes along with that, is like understanding the due diligence. And if you don't know, ask for help. And the reason why is I recently read an article where an investor admits, I didn't do my due diligence. First thing he says, he bought 2 homes, and this person was struggling to find properties on the market. So he's like, I'm just going to buy them at foreclosure. And this is where, ego is not your amigo. And person did not do their due diligence. They did not read the information. They did not pull a title report on this. Come to find out, the foreclosures were on second mortgages. And when you foreclose on a second mortgage, the first stays in place. So as an example, let's say my house is worth $500,000 and I have a first mortgage of $400,000 and I have a line of credit of $200,000. My house is upside down. I pay my first mortgage, my second mortgage line of credit, I'm not paying. So my line of credit will foreclose on me and they'll put a value of say up to $200,000. Whoever buys that though still owes my first mortgage $400,000 in most instances. Now some you have to combine the values, but we're not going to get into that right now. So this individual paid $100,000 on a property that is worth $200,000. So like, I am making a smoking deal on this. Paying $100,000, it's worth $200,000. The issue is first mortgage has $170,000 owed on it. So literally nobody should even have bid on that asset because $200,000 is really probably worth $150,000. So this person paid $100,000. Now let's say they turn around and sell this thing. Even if they sold it for $200,000, by the time you pay realtor commissions and everything else, you'll net $180,000. You got to pay $170,000. They make $10,000. So you paid $100,000 to make $10,000. So you lost $90,000 and time. So in this case, the person probably should just walk away. Person did mention, I'm going to have lawyers trying to negotiate with the lenders currently, but first position lenders will rarely negotiate. They don't have to. The next one's worse. Person paid $280,000 for a $500,000 property. Great. This is awesome. I'm getting such a smoking deal. Oops. They owe over $350,000 on this thing. And again, each one of these are in HOAs as well, which have significant fees. So HOA taxes, insurance would be, on the first property, probably chewing $1,000 a month hole into his pocket. On the second one, probably close to $3,000 a month, what they're probably biting, getting eaten for, or $2,500. So in both instances, person's like, now what do? You could pay off the properties. You could spend more money to pay them off and own them. And if you did that, the only recommendation I'd have is you hold them for a really long time and you start praying to, whoever you pray to. But the reality is this person would have to still put out another $500,000 to earn nothing. Is that the best use of your money? It's not. You're really at a point where you got to eat your losses. And in this case, it's going to be, close to $400,000 in losses. Now, people listening, that's a lot of money. Well, how would they have avoided it? $150 would have avoided that per property. $150. And this is where my mind just always gets blown, is people will get cheap and will spend hundreds of thousands of dollars on an asset without spending $150. So for example, for us in the note space, we put an offer in on a loan and it gets accepted. Our due diligence is we send somebody to look at the property, make sure it's still standing, it's there, and put an estimated value on it. That costs us between $50 and $150. We also run a title to make sure there's no title issues, no title defects. Now another $150. So we'll spend call it $300. Plus we'll have an attorney review. So we'll spend $500 on a $300,000 asset. I can't tell you how many people I know will skip over that process and will just roll the dice. It blows my mind. It's like buying a house without looking at it or getting a home inspection. It's just, I can't fathom, especially if you're using other investors' money. If it's your own money, hey, look, you want to be an idiot? go ahead, be an idiot. But no matter what business you're in, it's the little things that equate to the big things. And it goes back to the block, John Fish, CEO of Suffolk Construction, always used to tell me, goes back to the blocking and tackling. You got to do the fundamentals. You got to do the basics. If you do that, you win more often than you lose. And, if you block well, you're not going to get sacked a lot. And, you might not always, advance the football, but you're not having negative plays. In investing, you don't want negative investment. So I'm going to wrap up with that. And I hope everyone enjoyed this episode of the Creating Wealth Simplified podcast. For more information about us, our offering, or what we do, or if you're a buyer of loans or seller of loans, reach out. Our website is 7einvestments.com. And you can also reach out to us at invest@7einvestments.com. Take care. Thanks for listening. Catch you on the next one. Thank you for joining Lauren and I on this episode of the Creating Wealth Simplified podcast. Each week, we bring you expert education, experience, and information in a digestible format to help you identify investment opportunities so you can build wealth through real estate and take action toward your financial goals. Enjoy the show, share with a friend, or subscribe to the show and leave us a review.